What's going on, ladies and gentlemen? Welcome back to another pre-market watch list. Second, there we go. So welcome back to another pre-market watch list. Thank you guys once again for tuning in. Right now I'm streaming from my house, which I don't normally do, but I figured why not? We'll give it a go. So normally I'm working from the office, but tonight we're going to be working from home here. So I am going to be discussing with you something that I don't normally talk about, and that's a bunch of blue chip stocks in their current market condition. I think this is a good time to bring this up because there's so much talk revolving around whether or not we're soon to head into a recession, a stock market crash, et cetera, and whether we are or whether we're not, it's good to talk about these things. But personally, in my opinion, the stock market correction, crash, recession, whatever you choose to call it, it's definitely, in my opinion, coming. And that's why I'm going to be doing this stream tonight to discuss many of these stocks and many of these signals that I think are giving us signs that this recession or crash is upon us sooner than later. We had the scare back in the beginning of 2018. We've kind of recovered since then, but whether or not we've recovered a little bit, I don't think that's anything to get all hyped up about. I think the market is soon to be coming to a recession, and I'm going to explain why. There's many factors that you guys could be like, oh, well, it's interest rates this, it's the economy booming this, but regardless of whether or not interest rates are still low and whether or not the economy is still booming and there's so many jobs out there, regardless of all of that, simply today on this stream, we're going to be talking about stocks that are giving us signals that we might be entering into a bear market. All right. So let me go through some of these comments. What's up? I'm doing pretty well. INTC. NVIDIA did have a very, very good day. And here's the other thing, right? Someone just mentioned Pink Penny, right? You mentioned Amazon. There's many people out there that think since Amazon's doing so well, that Amazon is part of the reason why the market is currently staying propped up. They feel that Amazon's kind of the reason keeping the market up. So today we're going to be talking about why I personally think we're starting to see signals of a recession coming soon. All right. So I'm going to go ahead and we're going to start sharing the screen. But before we get to that, as you can see by the title of this video, there are 14 blue chip stocks. If you're not familiar, a quick kind of recap on a blue chip stock. Blue chip stocks are basically household stocks, something that you would naturally see in your home. Coca-Cola, toothpaste, Johnson & Johnson, Pfizer, Amazon, things like that. Bigger name companies that have been around for a long time, that are very reliable, that basically run the market. Over half of all the major big name companies that run the market have entered into a bear territory. So think about that. Out of the top 30 stocks that run the market that are named blue chip stocks, almost half of them are currently in bear territory, bearish times, right? Now, sure, they could recover, but over half of them are currently in bearish territories. And more than half of them just a few months ago were in bearish territory before a few of them recovered. So think about that. More than half of the industry leading big name stocks are currently in bearish territory. If that doesn't make you think that those might be some signals that we're entering into a recession, I don't know what will. Maybe until we crash, and then people will go, oh, well, now it's upon us. Well, you have to start thinking before it happens, okay? So, yeah, I said that in March too. Regardless, nobody can time the market perfectly. Regardless if I said it in March, and regardless if I said it in now, the people that always get hurt the most are the ones that aren't willing to accept the fact that the market is going to crash extremely hard. I personally think it's going to be worse than 2008. Now, this isn't meant to scare you guys. This is my input to help provide you with some information so you're not left in the blind. Because most people want to always think that things will be good forever, and it's hard to hear the truth. And whenever you get someone coming along like me to tell you differently, we usually get bashed and go, oh, well, you said it back then, you said it now. Well, brother, we said it here, we said it there. We're getting ready for it, and we're the ones who will be most prepared for when it happens, and we'll be the ones to capitalize on it the most over anybody else. So we'll start talking about that. So let me go into sharing the screen, okay? So I'm gonna start sharing the screen here for you guys. All right, we're gonna go to, we're gonna go to this one right here. All right, 1 second. Share screen, boom, boom, get that going. We're gonna minimize that, and we'll start here. All right. So here we go, right? So what we're gonna do right now is we're going to, or at least I am going to run you through 14 stocks. Now you're gonna get a little bit of a lesson, and you're also gonna get here an opinion-based statements, all right? So first things first, here you go. Here is GM. I'm gonna use a bunch of drawing tools to basically explain this, guys. Now, later in this video, I will recap and we'll go over some questions that you guys may have. But for now, just try and sit back, relax, pay attention, maybe grab some popcorn, enjoy yourself while you hear my beautiful voice going over this, okay? So first things first. Right now, we're looking at the stock General Motors. Everybody knows General Motors because you see their cars driving all over the road. Look at what we have here. This is what we're focusing on, this circle. And you could also say, you know, this one right here. If you're not familiar with what these two circles mean, these are what we call a death cross. We're looking at death crosses. Death crosses are referred to as very, very bearish moves. Whenever we have a death cross, this signals that we're potentially entering into a bear market. So some of you may be asking, what is a death cross? I'm going to zoom in. What we're focusing on is this right here. That. And this right there. What we're looking at is this red line crossing this purple line. This red line crossing the purple line in a downward move. Okay? This is what we call a death cross. Death crosses are bearish moves. It's when the 50 moving average crosses below its 200-day moving average in a downward move. Okay? Now, we're definitely going to get to questions and comments. We're going to discuss this in a little bit, but I'm going to first run through all these 14 stocks. So that is General Motors. Next one on the list. Now, MU isn't necessarily the a blue chip stock, but it's very big semiconductor stock that everybody follows. Micron. Everybody's been wondering when Micron's going to bounce back. Well, Micron is heading down towards a potential death cross. We have broken the 200 moving average. We have recovered, but we are starting to see a nice downtrend in that direction. Next one on the list is going to be Caterpillar. Caterpillar has now seen a death cross right there. All right. Next one on the list is, what do we have here? XOM, ExxonMobil. ExxonMobil has seen a death cross back when the market took a big dump, and it's now seen another, or very, very close to a death cross right there. All right. On to the next one. Keep going. CVX. Chevron has seen a death cross back when the market took, or no, sorry, it didn't see a death cross back when the market took a dump, but as you can see, it's starting to roll over. It has now broken its 200 moving average, and the 50 moving average is coming down to potentially test for a death cross. On to the next one. PG. You guys know this one, Procter & Gamble. Procter & Gamble had a big death cross. It has now recovered its 200 moving average, but the 50 moving average has yet to break the 200. So it is still a bearish long-term move. All right, on to the next one. And I'm going to be going through every single stock, so stick with me. MMM, 3M. 3M has seen a death cross. Back, where was it? Boom. Right there. There's a death cross on 3M. 3M is now in bearish territory. All right. On to the next one. McDonald's. McDonald's has seen a death cross. Where was the death cross at on McDonald's? Death cross is right there on McDonald's. Okay. McDonald's is now currently in a bear move, bearish territory. All right. On to the next one. Boeing. Boeing hasn't yet crossed, but Boeing's range You can see Boeing's range from its 200 moving average and up is starting to get smaller, which means this could eventually go like that. All right. Next one on the list, and sorry, this might be getting repetitive, but you have to see it. Oh, what do you know? AT&T. AT&T has seen a death cross a while back and has yet to even get over the 200 moving average. So AT&T in itself has been in a bearish territory for quite some time already. All right, next one on the list. I know you guys might be commenting, but I am going to go over all your comments here in just a second. INTC. Oh, what do you know? Intel. Intel is coming down to a potential bearish cross, okay, or a death cross. Next one on the list. Keep going. AA. All right, you have Alco Corporation, who has now seen a death cross. And there's only two more, I believe, and then you can stop hearing me go on and on. C. Citigroup has seen a death cross right there. Next one on the list is, oh, I think we already went over that. Yeah, General Motors. Okay, so we've already gone over that. Now, before I continue, I'm going to take the screen share off and go over some comments here. All right, 1 second. All right, so now that I've gone over all that and you guys have seen what I was talking about, now I'm going to go ahead and kind of look over some comments. Time for some puts. So I'm going to read through these comments, guys, as best as I can. Yeah, Native Gamer, you might have to rewatch it just a little bit. We're at all-time highs. You're saying the market's at a bearish time. So we'll cover that, Jordan, for sure. Yes. Okay, hold on. A lot of the, okay, Trump trade wars, okay. Okay. Okay, so I'm just kind of reading through, scanning some things to kind of know where you guys are at so I can kind of bounce some ideas off you. SPY is still above daily support at 280 a minimum. I would look for a loss, a week higher low. You can think of all you want about the stock market, but I wouldn't make a trade on it. Yeah, agreed, Arvin. Yeah, there's definitely no trade in the bear move of the overall market. But what we're seeing right now is all the industry leading stocks are starting to head towards bearish territory, right? So if I were a big time investor and I thought the market was going to start crashing, right? Think about it this way. If I had billions of dollars that I needed to move out of the market, would I start doing it right when the market's crashing? No, that'd be the worst time to do it because you get a lot of slippage. You wouldn't be able to move all your billions of dollars out of the market. So if I was a big time investor, someone like Warren Buffett, if I was running JP Morgan, if I was running, you know, any of these big banks, right? If I had billions and billions of dollars in the market and our team thought we're heading towards a recession, what we would start doing is we would start planning ahead. We wouldn't wait until we get an immediate for sure signal that the market's crashing or going through a recession. We would start taking our money out before we ever for sure knew. We would start pulling it out as we started to think. We start downsizing our positions. And what's going to happen if we were to start downsizing our positions, we would start to make these stocks turn bearish because we're pulling all of our money out slowly over time. So we don't crash the market. When people like Warren Buffett, you have JP Morgan, you have any of them, right? It doesn't matter. You have JP Morgan, you have Citigroup, Bank of America, any of these big name companies, big hedge fund managers, right? What would happen if they pulled all their money? Hold on, let me get a snap like that. What would happen if they pulled all their money out of the market instantly? They would crash the market instantly. Did you know that 80% of the money that's in the market is managed by institutions and hedge funds? So if all the institutions and hedge funds pulled a lot of their money out at one time, they would be the reason the market crashes right away. So they can't do that. They have to slowly pull their money out, okay? And what that's going to do is it's going to cause stocks to turn more bearish as they are pulling their shares and selling their shares. And they have to do it ever so slightly over time, so they don't just start crashing stocks. All right. Secondly, a lot of these big name companies, they don't invest in penny stocks. They're hardly ever invested largely in speculative stocks. They're very regularly invested in reliable, smart, and reliable, trustworthy companies, because these trustworthy companies, for one, pay pretty good dividends. They usually have good returns. They're safer investments. And that's why these bigger name companies, and for one, they're more liquid. They have a larger market cap, bigger floats, right? So they become a little less risky. And that's why a lot of these bigger name companies will use them. So a lot of times when you're starting to see a bear market upon you, the first signals you're going to see are some of these bigger name companies start to turn bearish, because that is where a lot of the institutional hedge fund money is located, in these bigger name companies. Now, of course, they have money that's dispersed all over the market, but a big chunk of their portfolios will always be in the blue chips. So a lot of times your blue chip stocks will be the first stocks to start seeing bearish times, right? Now here's the thing. Now here's where it gets very interesting. This is where you got to use your mind, guys. You have to think outside the box. Just by looking at a chart isn't going to tell you everything. If you want to get good at trading and good at investing, you have to use your brain, okay? So let me put it this way. After this video, there's many that are going to go, well, the Dow Jones is still up. The S&P 500 or whatnot is still up, right? They're going to go, well, all these major indexes are still up. Well, let me ask you this. The S&P 500 consists of 500 of the market's top stocks, right? 500 of the best, biggest stocks make the S&P 500 index, okay? So when you say the market or the S&P is still up, sure, because there are 500 companies in which that that index is weighted upon. So unless more than half or a bunch of all of those 500 companies start getting slammed, then the S&P 500 will still show an uptrend. What would happen prior to the S&P 500 dumping is you're going to start seeing some of these major stocks, biggest stocks, start turning bearish. When those start to turn bearish, there will be a domino effect that will then trickle down to the smaller companies that make up the S&P 500. Once the bigger companies weigh in on the smaller companies, you will see the market turn. And that's when the market goes through a recession. Okay? What will start is these bigger name companies going bearish, bigger institutions pulling money, things like that. Okay? So whether or not the market's still up, it's a good sign, but it doesn't mean that we're not heading towards a recession, right? Most people wait until it's too long, right? They're going to go, or like, here's a good example. Somebody knows that their car isn't doing so well. They maybe haven't gotten an oil change, their ball joint's going bad, their brakes are a little bad, and they'll go, well, you know what? It's still drivable. It still gets me from point A to point B very well. It's starting to get a little shaky, but, I can still get there, no problem. So I'll just hold on. And then next thing you know, you wait a little longer until your car breaks down. You go, well, damn it, I knew it. I knew I should have got my car fixed. I knew it was going to happen. Well, then why didn't you get your car fixed before it broke down, dumb shit? Okay, not dumb shit, but seriously, okay? That's the way you have to start thinking. Another thing, Warren Buffett and a lot of these institutions, even what's the guy that owns the Mavericks? I can't remember that billionaire. Mark Cuban. Right now, these big guys with a lot of money have more money in cash than they've ever had before. These bigger guys are holding little stocks. They're holding basically nothing in the market because they know that it's better just to wait for the recession than buy at these all-time highs. When stuff gets really high, how much higher is it going to go? Maybe a little bit, but what I can tell you is there more money to be made when it's at the bottom? We are at the high, so stop chasing the high up. Give it a break. Let it go through recession. That's what smart money's doing right now, okay? So let me go through read some of these comments. Hold on once. Oh, there's a lot of them. I'm sorry. Oh, wow. Okay, hold on. This is interesting. This is fun. Although the last recession we had, the stocks were doing amazing right before. Oh, we read that one. ATT stocks anyways, laugh out loud. Aren't most of these just happening because of the trade war talks, trade much smaller talks and this? So here's the other thing, right? People are going to go, oh, well, isn't it trade wars? Okay, there's going to be news in the market that always affects the market one way or the other. You cannot solely base on market reaction entirely based on one thing of news. Trump and the trade wars, realistically, Trump imposing taxes on China is probably one of the best things that could happen in the long term for our economy, literally. So the Trump trade wars, the only reason it may even negatively affect what's going on is because people don't even understand the potential that it could have for our economy, and they're just scared half the time. But you can't, just say, oh, well, the market's doing this because of trade wars. Sure, it has an effect, but regardless, it just so happens it's a coincidence. Markets at all-time highs, Trump becomes president, does some new things that people don't know anything about. They get a little shook. Sure, I get it, but no, I wouldn't say that the whole market recession and the way stocks look right now is all because of Trump. I wouldn't say that, but sure, definitely has an effect. What about buying volatility? I can talk about that in a little bit. Tammy, I will type the list here towards the end of all the stocks. Yes. Have I there's really no back test in my theory. Well, I don't really have to. What I can tell you, well, not that I don't have to, but Mr. Panna, what you should do is you should go back to 2008 and just before and look at all the major blue chip stocks and start seeing how they reacted before 2008. You will see very big similarities. So Nicholas, 50 crossing the 200 moving average can happen a lot of times when those moving averages are close. That would make sense, right? If your moving averages are really close together, then sure, the 50 moving average could dip below the 200 and come back over it. But when we go through a bull market, right, as we have, the 50 and the 200 separate. They become very distant, right? And then when they start coming back towards, that's where we're starting to get a death cross, right? Okay, just say hedge funds. Okay, hedge funds, cool. Did the fib enter Barrett? Facebook is almost. I would have to double check, but I think Facebook's 50 moving average is still above. It is 50. Facebook's 50 moving average is still above the 200 at this day. Yeah, Kit. So like low flow penny stocks are they're rarely affected by market crashes. There still is going to be volatility there, not as much as when the market's good, because when the market is really good, everybody's in the market. So there's more volume, a lot of times. And then when the market goes through recession, people get scared and they kind of lay off the gas of trading a little bit, but there will still be some moves. Okay. Yes, this stream will be posted. Late to the party, can't wait. When is your, so I think recession will be. I think we're gonna start 2019. I thought for sure it was March, like without a doubt. All those massive drops. I mean, to me, that was like, okay, this should be it, right? And it didn't, and that's okay. But that slam we've seen is something to note. It to me is definitely a sign of some shakiness and uncertainty. In 93, the SPY was 42 and some change. Yep. So, you know, that's a good comment. Jordan Fogel, or yeah, Fogel, that's a pretty good comment about, you know, waiting another year. I get where you're coming at. Hmm. No fears, guys. Keep charting the market until the crap hit the fan. Then we make option puts. Absolutely, with the option puts. Okay, so there's a lot of comments coming through, so you know, you guys kind of read them and go through yourselves. But now let's talk about this. I'm going to share the screen again. We're probably gonna go live here until about 9 o'clock. So just give me a second. I'm gonna go into sharing the screen, and we're gonna take a look at some other things real fast. Okay. We're gonna go over here. 1 second, guys. All right, so there is something I want to talk about. Now, this is, you know, just bear with me here for a second. All right, no pun intended. So the SPY, right? Okay, let me take off all these drawings. All right, so now we're going to actually focus on, and we're going to talk about the SPY. This is the ETF. We're not looking at the actual fund index, but we're going to be looking at the S&P 500 here. All right. Now, one more second. I got to pull up something. Here we go. Okay, now we're going to talk about the market, the S&P. All right. So as a gentleman just said, Mr. Fogel, I think his name's Jordan. Yeah, Jordan said so. You know, the market was up really big, right? You know, let's talk about 2017. So the market, and let me do it like this. We're going to go to, we'll do a 3-year week, right? So Jordan said that the market was up really big in 2017. So, you know, there's that idea here is, should we have stopped buying in 2017? And if we did, we would have missed out on a lot of gains, which is true. You would have missed out on some gains. But let me ask you this. As traders, we all know it's a game of calculating risk and reward. So let me ask you, is the risk worth the reward? And at this current moment, I do not think the risk is worth the reward. Sure, the market could go up another 5, maybe 10%. So you're going to try and tell me we're going to inch our way up to a 5-10% gain when the downside potential, let me show you. Let's do it like this. So you're going to risk, right? So you're going to aim for another 5-10% when the risk is how great, right? Look at it in this perspective, right? From 2008 low of $67 all the way to the current high, the market, oh, let me take that back. 1 second. So from the low of 2008 all the way to the current high, the market has gone up about 340%. Think about that. The market's gone up 340% since 2008 low at 67. If you're looking at what? If you're looking at the SPY ETF fund. Okay? Something else to know. Ready? Look at the amount of volume that was in the market when we were crashing, right? This is the crash of 2007, 2008. Look at all the volume. Now look at the volume. Hold on, let me do it better. Ready? Want to see something? Ready? Look at the volume. The volume in the market is starting to slowly decrease, meaning there's less people that are hopping into the market. Market steadily decreasing, meaning if volume dries up, there will be nobody left to buy it, to push it higher. So there's another signal, decreasing volume. When we start coming down, volume will pick up, but you need volume to keep pushing higher. Okay? Volume is steadily decreasing in the market. Now, if the market's All right, can you guys hear me? Am I coming through now? Sorry about that. All right, let's see if we can get this back up and going. 1 second. There it goes. There it goes. All right. So I don't know what happened. Literally, internet just like shut off for half a second. We're back on. So we should be good. All right, awesome. Thank you. Because I was on a roll there and I didn't really want to have to end it there. So you guys see that what I was going over is the market's up 330% since 2008. So, you know, you have to think to yourself. Now, again, right, it could go up another 40%. It could go up 50%. But after going up 330%, are you really going to try and risk those extra 10, 20% when the pullback could be? Let me tell you this. The market could pull back 50%. So you do the math. 330%. If the market pulls back 50%, 300 is 150, so 330. So you're looking at 165% pullback in the market if we went through a big crash, right? If we went through a big crash similar to 2008, I think we'll be worse than 2008. You're looking at 165% decrease in the market. So you're really going to try and inch your way up another 10% when the risk of 165% could be upon you? That does not make sense. I wouldn't do that. You know who else wouldn't do that? Warren Buffett. You know who else wouldn't do that? All the major hedge funds. So if they're not going to do it, why should you? Interesting. So what would be a better way to do this? Start anticipating the market's going to crash, because it will. Markets go through a recession on average every 5 to 7, 8 years. We have, well, actually, it's more like 5 to 6, 5 to 7, but still, every 5 to 7 years, we usually go through a recession. The market has not gone through a recession since 2008. That means we have gone on a bull run for 10 years. 10 years with no recession. That is not normal. That is not normal, which means the pullback or the recession will probably be far greater than anything we have ever seen before. Think about it. If this is the biggest, and it has, this is the biggest bull run ever, which means the chances of the biggest market crash and recession is more likely than ever, right? Definitely not normal. This is not a normal bull run, right? This is not a, 1 second. Let me do something crazy here. Let's look at, I don't even know if I can pull this up anymore. Yeah, I can. We're going to look at, let me show you something here. Now, I know penny stocks have nothing, I know penny stocks have nothing to do with the market, right? I know that. But let's look at this, right? I know penny stocks have nothing to do with the market, but we all know that things can go parabolic. So we're going to take a look at the stock LFIN. Now, I know some of you are going to be like, well, this is completely irrelevant to the market, but it's not in a way. So we're going to do it like this. We're going to do 180-day, 30-minute. 1 second. That still doesn't really look good. Hold on 1 second. Let me do 180-day. We'll do 180-day 5-minute. That'll do the justice. Okay, I'm going to zoom in here. This is LFIN, right? This is the stock LFIN that went from $6 all the way to $142 in 2 days. Now, granted, this is like super freaking abnormal and this never happens. But look at, the stock went from $6 to $142. It went absolutely parabolic, super nuts, something we've never seen before that does not happen very often. What happened? Ready? So from its starting point at $5.60, it went from $5.60 to a high of 142, which is 1,980% in 2 days. Okay. Once it hit its high at 142, it pulled back. How much? It pulled back. That doesn't even, oh, well, I guess, yeah, that makes sense. So let me do it like this. So it went from 5 to 142, then from 142 all the way down to 42. So it gave back more it gave back more than half of its gains that it made over the past 2 days. Sure, it recovered a little bit, but that just goes to show when things go parabolic, when stocks make an unusual, unnormal, never before seen move, they usually result in a massive, massive scare and a massive, massive pullback. And this is something that you should expect can very easily happen in the stock market. And why is that? Well, that is because the market has never yet ever gone on a, oh, that's wrong, daily, right? Market has never gone on a bull run like we have ever seen before like this. So let's do some simple technical analysis, right? So let's just say we do a basic Fibonacci. Now, some of you may not know Fibonacci, and I don't use Fibonacci like crazy, but I can tell you right now, a basic Fibonacci will tell you that if the market did pull back 50%, the market is going to pull back down to 178. It's going to lose a little bit more than 100 points on the SPY. If it pulls back to the 61.8% retracement, then the market will pull back to the previous highs of 2007, which is going to be right around 156. So that's a massive drop, right? Pretty big. I don't necessarily think we're going to go that far, but it's possible. I highly doubt it. Chances are, if the market goes through a recession, we're going to see it pull back about 50% of the move that it's made, which means we're going to result in a price around 178 on the SPY ETF, okay? So think about that. You see where this line is? And let me get my drawing tools up 1 second. Oh, I can't. Oh, wait, hold on. Give me just a half a second so I can do something here. Okay, share screen. We're going to go to this one. Boom, boom. All right. I know this might be getting repetitive. I hope you guys are following. Right? So if the market were to pull back to this 50% retracement level, that means the market is going to come down like this, all the way from boom, boom. And now let's make that bigger. It means the market's going down like this. So when I ask you, is this a good time to be buying? Probably not. But right here, down at the low, that's probably a good time to buy, right? So let's think about this. Should we be going long here, or should we be going long down here? Probably down here, okay? So whether or not we're going to go up another 5–10% doesn't matter. All that really matters is this is the biggest bull run we've ever seen. It will end, and when it does end, this is probably going to be one of the biggest drops in the market we have seen ever. Boom. Okay. Now let me take the screen share off here. So give me just a half a second. Stop sharing. So it should be going back to my face in a second. Yeah, it is. All right. So, all right. There we go. Back on. So now I know LFIN was a scam, and there's, you know, and again, to relate a stock like that to the market, there's obviously, you know, some questionable relation there, but the concept is there. When stocks go parabolic, they usually result in a big so if a stock goes parabolic to the upside, it usually has a massive drop thereafter. If a stock goes parabolic to the downside, it usually has a massive squeeze thereafter. If the stock market goes on a massive, massive bull run we've never seen before, we're probably going to see a massive, massive bearish move thereafter when it ends. It just makes sense. Okay. Now for day traders, right? For day traders, this doesn't even matter. As me, I hope the market goes through the worst crash we've ever seen, because my job isn't affected. It's not. I trade the market day in and day out for money. I look for volatility. I look for fast, big moves in either direction. So for me, it doesn't matter. My job's not affected. It actually makes my job better. I'm going to get a pay raise on the short-term day trading side of things when the market crashes. My retirement accounts, sure, they're going to get hit, but that doesn't matter because it's the long-term haul with their retirement accounts. But I can tell you right now, for some, you might want to start thinking about the way your portfolios look. The people that are managing your money, are they starting to look into Treasury bonds? Are they starting to move money into safer ETFs and things like that, right? You really don't want to be all diversified into just plainly stocks, while the market, that'd be bad. So, uh-huh.